Good morning, our panelists. USChina Minis of Blue FX Nigeria, the managing partner. Good morning. Welcome to Frontier Opening Bell.
Good morning, boss. Thank you for having me.
It's great to have you today. And Chima Ukadike, who is a consumer goods analyst at Vetiva Capital Management. Chima, it's good to see you also on the show.
It's nice to be here.
We thank you both for coming through this Wednesday, the 26th of August. Look at the continental equities market, a bit of a mix there. The South African market was up 1%. Kenya was up 1.03%. The Egyptian market at 0.25% in the green territory, the same margin for the Nigerian Stock Exchange. But the Ivorian market bucked the other four major exchanges we track on a daily basis by 0.17%. The markets are looking forward to a lot of stories today, but let's look at East African marketplace, where a new chairman of the Nairobi Securities Exchange this morning took over. But the warning from the central bank in Kenya was that there is this Ponzi schemes becoming pandemic, unregulated and fraudulent Ponzi schemes, financial market schemes back within this pandemic period, asking Kenyans to be very wary. Report says that Kenyans have more money in their bank accounts during the pandemic lockdown period than any time in history because they spent less and because they were unsure about the future. Everybody tried to keep a tight pulse during the period. Meantime, Uganda shillings was flat on Tuesday on the appetite for FX by telecoms, fuel importers, and others. East African breweries yesterday secured a 3-year deal to meet the terms of a 6 billion shillings bond from investors. And a very surprising rating from Fitch, affirming B+ rating for Rwanda in East Africa despite the risks to the downside. So globally speaking, it was a very interesting Tuesday. Again, the US-China phone calls about trade, dollar was down as well. Uche, how much of these global stories had impact on the frontier and emerging markets?
I think it sort of gave those market fronts a boost. After the announcement, we saw the Chinese yuan appreciate by another 1.3% on the back of that news. And that in itself created that ripple effect into frontier and emerging market, because the downside to that, or the positive side to that, is that we saw the dollar trade lower. So that in itself elevated that risk of a possible rebound in the US dollar. I think as it is, we are already used to this, really. The optics, the narrative that, oh, we are working on a phase 1 deal, just to continue to bolster the market, not try to shock the market in any way. And the Chinese are passive aggressive. You will never see them come to the forefront to get any form of fight or offensiveness of some sort, you know. So anytime the US comes and say, oh, let's talk or let's have that conversation, they're ready to do that. But underneath the scene, they are really not meeting their obligations. Right now, we're seeing US farmers' bankruptcy increasing by another 35% year on year. That is showing to you that the Chinese are not buying as they should buy. Obviously, in their there's a caveat in the trade deal, phase 1 trade deal, saying that if there is a pandemic or a first major event, they have that should I say mandatory obligation to not meet their buying target. And that's what I've been seeing all through those farming states, because the Chinese cannot meet up the demand, as it were. So yes, we'll have a lot of this. Oh, phase 1 deal is on there, is on the radar. We are doing this, we are doing that, but really, in actuality, it's not being implemented. And that's basically what we're seeing. We're seeing a highly speculative market right now. That anything you put out there into the market, into the mainstream media, the financial media, will sort of drive the market, will drive asset prices, will drive anything that has people to react, because a lot of people are really just speculating right now. There's a lot of veto holding in the market. So people that don't exactly know about fundamentals, price valuations, will just jump in if they see anything or consider anything as positive, really.
Interesting, the currents and stories around the marketplace about a bubble building up. Even the tech stocks rally. Some warnings from bank credit analysts in the US yesterday says there's a tech bubble out there and everyone should beware. That's what they published in a report yesterday. But just a few more, we'll get back to this market. We'll talk about the Southern African market, but let's talk about Nigerian market. Today we're expecting some auctions by the financial regulator, but the central bank, the biggest story is going after exporters hiding FX proceeds overseas. Banks to submit names, addresses, BVN of default exporters. The central bank is throwing everything it got right now into the fire, trying to make sure that the more FX stays within the country and those outside are brought in. Meantime, the regulator is also trying to clear the mess as far as the payment within the electricity value chain is concerned. In Ivory Coast, cocoa farmers are looking forward to a favorable weather, if that will help the output for this year. Meantime, Senegal has issued a warning that they have about 2,700 tons of the type of chemicals that blasted through Beirut, causing dozens of deaths a few weeks ago. They want to see how they'll move these chemicals out of the seaport in Senegal and move them inland. The company involved has been notified to do that with immediate effect. Chima, what's the big story that you folks are looking at Vetiva Capital from the central bank angle with these FX running around trying to make sure everything works out?
Thank you, Basin. So the big story would be the first two stories you mentioned with regards to the CBN moving to exporters that have tried to sort of hide their proceeds from exports, as well as the tackling of the second story, which is to, excuse me, I totally forgot. But our focus is on the CBN's move. So we know that because of the opening of the international airspace, they have recently tried to ramp up their modes of shoring up their FX revenue, FX reserves. We've seen that they have tried to eliminate the middlemen in the supply chain of importers. So instead of having middlemen get from M's and then inflate the prices for some of these imports, they want the importers from the local importers to actually liaise directly with the suppliers of the foreign raw materials. So we are seeing that as well as the move towards against the hiders of foreign FX proceeds to shore up their FX reserves. So I think all that is in line with their strategy to help the FX market. We know that they have been under some pressure from international bodies to unify the exchange rates, and we know that in next 3 days there'll be some there will be a resumption there will be an opening in the international flight space, and all that will put some pressure on FX liquidity. So I think these are just some ways the CBN is trying to make sure that the pressure from demand on the FX market is a bit subdued, so that they will not have to so that there will not be that increased gap between the various FX rates that they are managing. So we've seen that there has been some increased FX sales over the past days, over the past week. We've been seeing some increased FX sales, and we think all that is just in line to improve the FX supply in the market so that they can stabilize the FX rate in a way.
Okay, thank you, Chima. Let's talk about the FX and oil prices a little bit. When we look at the Southern African market today, the South Africa's PPI and consumer price index, which is called inflation, is out this morning. Early yesterday, the rand firmed up 0.5%. There was a change of guards. Netbank CFO Ms. Morathi has moved into the same role at Vodacom. She's resumed there right now with immediate effect. That's already in the news. Mauritius is still trying to deal with the Japanese vessel that spilled oil all across the Indian Ocean, part of where Mauritius is. And diamond prices has been cut by 10% by DBS, trying to raise demand that slumped during the coronavirus lockdown. But again, when we look at the oil market, oil prices, Brent 46 this morning, US oil 43. USChina, where does all this mean for Nigeria when Goldman Sachs also put out a report and says Nigeria's GDP output will be slowed down significantly because the country's relied on oil, and doesn't see any major GDP recovery to the rest of the year?
Right. I think in a way they're sort of indirectly pointing that they don't see any significant upside in oil prices towards the end of the year, really. I think we are going to just have some sort of hovering around that price area, 40, 45 region. And if that's not the case, we actually need a $75 really to sort of offset our, should I say, revenue, and obviously whatever inflow we'll be needing in terms of, should I say, bolstering GDP. So that is actually significant in terms of what Goldman Sachs is trying to picture out there. That we don't see really significant upside in oil prices, which I totally agree with. If all of these things that we're seeing in the market start to break down again, we might see another trade lower, really. So the risk reward to the upside is sort of limited. More, should I say, palatability towards the downside, really, in terms of risk reward. Should I say, setup. So I think Nigeria in itself we've put ourselves in this corner. We are heavily reliant on oil sales, and this is why it's even also translating into our FX reserve and also directly affecting our exchange rate too. It is what we have done. We have not done anything. It's like we've not grown in any way, you know. Every single person, or every single, should I say, country that has the basic thought process knows that you can't really rely on a particular commodity as if you want to put yourself in a place of advantage in terms of any form of crisis, you know. And when you look at this, when you look at the towards the first quarter of the year, where we had that oil price war, where Russia and Saudi Arabia could say, you know what, we don't care about oil prices. The fact is, they really do not care short-term, medium-term. Yes, long-term it might come to affect them, but there are other venues that they've set up in terms of infrastructure, in terms of the countries look to gain any form of revenue. So it's still very sad for us as a country that anytime oil prices get to dwindle, in any way we are all running helter-skelter. We're talking about recession. We're talking about even a possible depression, you know. It's saddening and very unfortunate, really, boss.
Yes, very sad and unfortunate. Each time we get rattled by oil prices. By now, we ought to have widened things, widened the pipeline a little bit, and bring more products into our revenue pipeline, mainstream a few more very quickly. We've got so many years to do this, but we haven't even used the oil prices, even at very good times, to widen the pipeline, have a product mix as you will have in the consumer goods sector, for example, Chima, isn't it? When you look at the consumer goods space, Nestle, Cadbury, flour mills, what you do is that you have a major product, but you have other products as well. So you have a diversified portfolio, isn't it? So that it helps you. But again, look at part of this Goldman Sachs report that says the easing of the lockdown, which we've now seen across board, will support partial rebound in domestic demand in the second half of the year. What's your take on this for FMCGs?
I completely agree with them. Like we had said before, earlier, we had noted that there has been a resurgence in economic activities. Like we had seen that there had been a shift in people's attitude towards the pandemic, and we had seen that had increased the level of economic activities from SMEs, local domestic players, as well as the bigger corporations and all that. We had also seen that affect the sentiment in the consumer in the markets, in the ASI, and we had seen that affect this consumer goods sector especially. We had seen investors more interested in that sector, picking on stocks that had been beaten down between Q1 and Q2, and then bargain hunting on those stocks. So we had seen that affected already. Going forward, we also think that because of the increased expectation for economic activity to increase, people are really people don't really want to stay locked down for a lot longer. People are not really so afraid of the pandemic, would I say? And we expect that to affect the economy going forward positively. One, in terms of income, we'll see people going back to, maybe not going back to the previous levels of income that they were on previously, but we'll see that it will be better than what we had expected in around Q2. So we expect that to increase consumer wallets positively. Maybe not as great as we would want to maybe bring us out of a declining GDP and so on, but we expect that to be positive. So I quite agree with them, and I see that in a positive light for the consumer goods sector, which solely depends on the prosperity of consumer wallets.
Interesting thoughts about some of these stories. Look at the North African market just very quickly as we take a bit more of your thoughts across the bigger stories. Then we try to round up the show. Libya, the fate of oil exports hangs in the balance. The warring parties or the warring generals are yet to agree to a deal. So the earlier thought that the oil exports will resume at the ports is now longer looking very feasible. Meantime, Sudan, according to Global Financial Integrity, lost $2 billion in trade misinvoicing in the oil sector between 2012 and 2018. And Tunisia, the new prime minister designate has named technocrat members and decided not to choose any from the warring political parties. The prime minister asked the political parties to sort themselves out. Meantime, he's going to move on and bring in members into the cabinet who are professionals, technocrats, to get the economy running. Meantime, South Sudan says it wants $250 million from Afrexim Bank for the country's full security and support the fight against COVID-19. Uche, let's talk to this the story around the oil market and finally Libya. Do you have any thoughts around this country?
I think Libya is quite volatile, and I don't think right now the OPEC Plus bloc would literally have to factor them in their plans really, because of their heightened volatility when it comes to the war, their supply of oil, and that in itself I think is a smart way. I think they were not really sort of significantly drawn on in the last meeting, and that's because there is no clear-cut, should I say, position that they are standing on really. I think that in itself put Libya in that precarious position whereby they can't even have that forecast in terms of what they can look to do revenue-wise, you know. So that's I think that's the smart way to work around their variable. But as we said before, OPEC is really treading its floor cautiously as regards not to being overreactive in terms of the variables really. One of the things they just highlighted in their last meeting was that the laggards, who are the countries that member countries that didn't comply, which Nigeria is leading the pack, I must mention, needs to really overcompensate going into September, October, and even possibly into the first quarter of next year, because also the period where member countries were needed to cut, there was still a shortfall of 3.7 million barrels per day. And this is with Saudi Arabia overcompensating, because if Saudi Arabia didn't overcompensate by another extra 1 million barrels per day, it will be 4.7 million per day. So what Russia, that's Novak and the OPEC GMMC chairman was saying from Saudi Arabia was that they can't have laggers to be consistently not meeting their production quota. But the truth of the matter is, look at the condition we are facing, we domestically. The reality is, even if we want to meet our production cost, it is not feasible for us to meet it because we need as much FX revenue as we want. You know what I'm saying? So that in itself is a problem. We can agree on the member country front with OPEC, but the reality is there's so much domestic and local pressure that you can't really put that implementation down to the T.
It's a very tight rope for Nigeria to walk really, because if price is looking good, you're not going to get $75 a barrel. Forget it. Not this year, unless something falls right out of the skies, but anything outside that, we're going to manage 40 to the end of the year. You can't get 75, and our output is not meeting any of the forecast that we have in the MTEF and the annual budget, by the way. A final thought from both of you for 1 minute each. The central bank is moving into trying to sort out electricity collections for discos, gencos, and the rest of them. Chima, do you think this will help a little bit?
Of course, I think this will help in terms of transparency, like they have said, remitting funds from the discos to MBET and the TCN. However, I think that this puts the discos in a disadvantaged position, given that their revenue generation capabilities are actually, did I say, under attack. They are not yet able to charge cost-reflective tariffs like they have complained over time. They have also been unable to effectively collect revenues, and they have also been facing some transmission, there are inconsistencies and leakages in the transmission line from the generation to transmission to distribution. So I think that while this would help the TCN and NBET companies, this would also be a disadvantage to the discos.
Interesting, just as we were having this conversation, the news is that USChina, Mr. President, has approved the cost-reflective tariff for electricity within the Nigeria space. That came to the news this morning. So a lot of developments are moving on very quickly. USChina, what's your take?
We're actually all Nigerians here, so we don't need to should I say, be on the high horse. I think yes, we can say that's a welcome development, but I've had conversations with a top, should I say, executive in one of these discos, and one of the issues they are facing is the infrastructural problem, really. You know, there is not enough people that have access to the metering, should I say, infrastructure, really. There are significant number of Nigerians that don't have any prepaid meter, and a lot of these things are estimated billing. And some people would say they don't have these things because when they lose so much money through estimated billing, they can't really factor and what do you call it, accurately measure what the electricity input or distribution is. So that in itself is leading to, as Kim has rightly said, too many leakages. We have a serious infrastructural problem. If we don't sort that out, really, all of these policies, all of this regulatory, should I say, measures to enhance electricity production distribution, is just going to be like water under the bridge, really. We need to really take care of these things so that when we're putting these measures in place, they would really affect optimistic and positive, should I say, outcome from this thing.
You're just correct. You can't build anything on nothing. You can't build something on nothing. You need to do that. But again, the policies of payment collections for electricity is what customers bring forward. For those who are not paying, for those who are tapping electricity illegally and all of that, it hasn't removed quite a whole lot. It's just to streamline what comes in and who it goes to within the system. Quite a whole lot of housekeeping we need in our electricity sector. Thank you both for your time this morning. Chima Okadike of Vetiva Capital, good morning. Thank you so much. It's good to have you this morning on the show. See you again next time. USChina Minis, the managing partner and FX trader at Blue FX Nigeria. Thank you both. We appreciate your time.